Hey guys, today I'm going to talk about a company that was founded when Abe Lincoln was president. It's in an industry that predates the Pilgrims landing on American shores, and it has a kind of dividend growth record that a lot of old school investors love. I know that sometimes old companies can be hopelessly out of date, or even defunct. It's not like any of us are investing in Zenith, or Schlitz, or Kmart, or Enron these days. But sometimes, old is not only still relevant, it's still wonderful, and sometimes even superior. And for our Income Builder portfolio, we just bought a high quality, A-rated, dividend-growing company that can truly be called a golden oldie. Hi everybody, I'm Mike Nadal here for the Dividends and Income channel. Before I get going, can you do us a favor to help us grow our channel? Pop the thumbs up at the bottom of the video, subscribe, and ring the bell so you get notifications of new videos as we publish them. I'll get to the blue chip company we just added in a second, but first a quick word about the Income Builder portfolio. We launched the IBP at the beginning of 2018. It's been funded by the $2,000 a month that this channel's co-founder, Greg Patrick, allocates to invest on his behalf. The IBP now has 45 stocks worth a total of about $125,000, and they combine to produce more than $3,100 in annual income. The portfolio's income target is $5,000 in annual dividends within 7 years, and we're well on our way to getting there. On our IBP homepage, you can see every stock in the portfolio. There are also links to every article I've written. So if you'd like to learn more about the IBP, make sure you check out the link in the description. Okay, so let's get right to the stock we added to the IBP. It's the world's largest railroad company, Union Pacific, symbol UNP. Yeah, trains are old school, and then some. Early versions in Europe date to the 1400s. The first steam locomotives in America operated in the early 1800s, and it wasn't too long before railroad tracks were being laid down everywhere Americans wanted to go, from sea to shining sea. Union Pacific was part of that landscape, incorporated in 1862. By the mid-20th century, though, trains had lost a lot of their luster. If you needed to get somewhere fast, you took an airplane. If you wanted to get somewhere economically, you drove a car. But you know what? Trains really aren't so yesterday after all. They're one of the best ways to transport industrial, agricultural, consumer, and energy-related products from Maine to California and every point in between. Railroads are incredibly profitable businesses, and many dividend growth investors say no portfolio is complete without at least one of the big North American operators. Renowned investor Warren Buffett recognized that, and in 2009, his company, Berkshire Hathaway, bought the Burlington Northern and Santa Fe Railway, now known as BNSF. Buffett explained that he wanted part of a business that was going to be around for hundreds of years, that's interwoven with the American economy in a way that if the economy prospers, railroads will prosper. Buffett also said it's the most efficient and environmentally friendly way to move goods. In 2020, Buffett's BNSF was the North American revenue leader among railroads, but Union Pacific was right there, and no other line was especially close. You and I can't buy BNSF stock because Buffett took it private, but we sure can buy shares in Union Pacific. And that's just what we did on Monday, September 13th, when I executed a purchase order for $1,000 worth of UNP stock for the Income Builder portfolio. Why did I pick Union Pacific? Well, for one thing, it's been a great performer. With a total return of more than 500% over the last decade, Union Pacific has outpaced rivals like CSX and Norfolk Southern, and it's absolutely crushed the S&P 500 index. During the second quarter of 2021, Union Pacific showed 63% year-over-year growth in earnings, 59% in net income, 50% in operating income, and 30% in operating revenues. Strong financial metrics are nothing new for United Pacific, which has an enviable record in terms of return on equity, return on invested capital, operating margin, and free cash flow margin. Investing is always a forward-looking game, and United Pacific raised several of its growth projections for the 2021 fiscal year. Now let's talk for a minute about Union Pacific's dividend. In May, the company announced a 10.3% dividend increase, its 15th straight year with a raise. And the railroad's average dividend growth over these past 20 years, 16%. That's impressive. Of the 7 Class 1 railroads in North America, 6 are publicly traded, and Union Pacific is the only one yielding 2%. Within its second quarter earnings presentation, UNP said it was targeting about 45% of earnings towards its dividend. That's a reasonable and healthy target, and it bodes well for investors. For 2022, Union Pacific's earnings per share is expected to be $11.30, and that means the dividend could grow by as much as 22% next year. Now, it's important to remember that earnings aren't guaranteed to meet projections, but it is comforting to know that even in down years for earnings, Union Pacific has increased its dividend. Yes, we're talking about a high-quality operation here. Morningstar assigns Union Pacific a wide moat rating thanks to its competitive economic advantages. Value Line gives the company its best scores for financial strength and relative safety. Union Pacific gets a solid A- credit rating from Standard & Poor's, and Simply Safe Dividends gives the company a very safe score of 88. And here's the Jefferson Research financial sonar of the world's largest railroad. As you can see, it's an awesome company with a great balance sheet, strong earnings, and outstanding cash flow. Union Pacific's one wart, according to Jefferson Research, Their analysts think the stock is overvalued. So what do others think about UNP's valuation? Of the 17 analysts surveyed by TipRanks, 13 say Union Pacific's a buy, and their average 12-month target price represents a 21% upside. As far as a few specific analysts, Argus has a 12-month target price of $250. Credit Suisse is really bullish, with a $264 target price, and Value Line's analysts believe the stock could appreciate more than 50% over the next 3 to 5 years. Value Line is so high on Union Pacific that their analysts have the company in 2 model portfolios, one for conservative investors and the other for aggressive investors. In other words, all aboard Union Pacific. Morningstar's analysts like Union Pacific's business, but they say the stock is trading at too high a premium. They have a fair value of $183. Using fast graphs to compare Union Pacific's current price to its 10-year history, the company does look moderately overvalued. But a look at the 5-year picture shows that UNP's current valuation is right in line with its recent history, suggesting that the stock is fairly valued. And with earnings expected to grow by double-digit percentages over the next several years, that could be attractive for a lot of investors. There obviously is some room for interpretation when it comes to valuation, so make sure you do your own research and invest to your own comfort level. One thing's for sure though, the railroad industry is an oldie but a goodie, and great ones like Union Pacific have been making investors smile for years and years. In picking UNP for the income builder portfolio, I think the company is going to chug along just fine for many years to come. All right, that's it for today, everybody. I'll be back in a week or so with another video. Again, please give us a thumbs up, subscribe, and ring that notification bell so you don't miss out on any of our new content. Take it easy, everybody. Back at you soon.